The Fed is projecting higher economic growth ahead than they were originally and higher inflation than the previous meeting, yet no changes in the Fed's path or decision. So the question, of course, is why is this the case? Afternoon, happy Thursday. Hope everybody enjoyed the very sunny weekend and excited to get into some things here this week because we have a lot to cover with the Fed decision and press conference just yesterday on Wednesday. My name is Brandon Steele, financial advisor with Mainsail Financial Group, and our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. And probably no surprise, but this week the entire focus is around the Fed. And although on the surface it didn't seem like a lot had changed, between the lines, there's certainly some messages that we want to break apart a little bit here this week. So we're gonna really dig into that, and that's going to be the entirety of what we cover here for this week's update. So again, Fed decision and press conference was just yesterday on Wednesday. The reality is that on the surface, there's no changes made. They're not cutting rates. They're not increasing rates, keeping rates where they're at. They are still projecting 3 rate cuts through the end of 2024. So again, on the surface, all seems status quo. However, the Fed is projecting higher economic growth ahead than they were originally and higher inflation than the previous meeting, yet no changes in the Fed's path or decision. So the question, of course, is why is this the case? One of the things I want to highlight is they said that they were expecting, I think it was 2.6% core inflation by the end of the year, but 2.8 in February. So if you think about it this way, what they're projecting and where we are today, it doesn't show signs that there's going to be a lot of inflation coming down through the course of the year. And for those who do tune in weekly, you're very familiar with the fact that we really believe that inflation is going to be stickier than many expect. This is a sign that maybe the Fed's getting on board with that as well. And it's not to say that we don't expect inflation to come down. I just think that to get from the 3 to the 2 mark is going to be much more difficult than it seems on the surface. And certainly the Fed's projection might be highlighting that as well. The Fed had come out time and time again, and one of the things I noticed was a lot of confidence in this idea of the fact that inflation is going to come down to 2%. The Fed seems so confident in that fact, said time and time again, we will get inflation down to 2% over time. And it was like, we will do this, we will do this. And I guess the takeaway from that is obviously they feel confident in that, but I would be cautiously cautious in how we view that, because if the Fed is that confident in the fact that inflation will come down, my concern would be that they do cut rates too soon, and then we see inflation pick back up, and we're in a really tough situation in that example. And in fact, the Fed highlighted that as well. Although they kept saying inflation will come down to 2%, they also backed that up by saying they really understand the risks of both sides of this coin. They understand the risks of cutting too soon and the fact that inflation could come, rearing its head right back up. They also understand the risks of keeping rates too high and how that could impact the economy. So it was a lot of mixed messages. But obviously, if you follow the markets, you probably saw the markets were up pretty big yesterday on Wednesday through all this and are up again today as well. So the message the market took away from this is that the Fed is all but looking for a reason to cut rates. Now, I don't know if I got the exact same message out of it. I think it was definitely more so that way than the previous meetings. But I think that the Fed did highlight time and time again that they're going to follow the data. The reality is I think this was a continuation of the previous meeting. But what I think is important in some of the messaging from this meeting is that they did open it up for future cuts much more than they have in the previous meetings looking backwards. So I would agree with that general message. But again, I don't know that this meant necessarily that cuts are on the way for sure. And again, if you look at some of the projections moving forward, it's still suggesting 3 rate cuts. But one of the things I did want to highlight is when the board gets together and talks about where they see policy moving forward, they have all the members measure what they expect or record what they expect. And in this example, 8 of the 19 members suggested 2 or less cuts in 2024. So keep in mind that if one other member would have suggested the same thing, if one other member thought 2 or less cuts, the conversation we'd be having today would be entirely different. The market would not be up In fact, the market would probably be quite a bit down because they would see a Fed that is maybe keeping rates higher for longer than even many expected at this point. But because we were one over, obviously, that paired with some of the language that the Fed had shared, it kind of created the situation that we're in right now. So just kind of take this with a bit of a grain of salt. Again, there's so much focus on the Fed now. It's a bit of a challenge because really, when we're hanging on every word that they say and really looking in between the lines on every single point that's made, it creates a lot of room for discrepancy. And obviously the markets are really liking it, but time will tell what the Fed actually ends up doing moving forward, of course. And if we do get another higher inflation read, that could completely change what we're talking about right now. Again, it only takes one more member to go the other direction, and we could have a very different situation on our hands. So just take this with a bit of a grain of salt. I would certainly be watching the inflation data really closely here moving forward. If the next inflation number is not back to where it had been trending, this could shift very quickly. So again, I would certainly keep a really close eye on inflation after all this. The other thing I do want to highlight is that a lot of the conversation was also around the exploration of slowing the pace of the asset runoff. So the Fed has increased their balance sheet significantly over the past 10 years or so. And so one of the things that they were talking about, they've been doing is selling some of those assets, and they're talking about slowing that pace. So this is important to watch because this impacts money supply. For those who do follow this closely, we talk a lot about M2 money supply. In other words, the money in circulation out in the economy. And if the Fed does do this, it will impact money supply and therefore inflation. So this is an important policy that I feel like was skipped over. We talk a lot about rates, but in reality, I think the money supply is the more important thing to watch. And so the Fed policy around the balance sheet is certainly something to pay close attention to as well. So with all of this, it just seems to me that, I think that it is fair to say that the Fed kind of in this message suggested that they might be looking for a reason to cut rates. And whether they do or not is a whole different story, but it did seem like they wanted to open up that can of worms so that they had the ability to in the future. Whether they do or not, again, is the biggest question. But based on yesterday's conversation, it just seems like there's something else that they may be watching or something else that might be brewing here because the data would suggest that the Fed should have been more conservative, wanted to keep rates higher for longer. And the message we got from the Fed was the exact opposite. Again, if the Fed is projecting higher inflation and faster economic growth than they were last meeting, there's no reason that the answer should be the same or even a little bit more, the word dovish, even more dovish message from the Fed. So we'll see what comes. Obviously, the May meeting is going to be an important one to watch. But nonetheless, I think inflation is really going to be really critical to watch in this next print because unless that comes back to the trend we were used to, it's gonna shift the conversation quite a bit. So hopefully that was helpful. I do want to touch briefly on jobless claims that came out today as well, which came out slightly below expectations, but mostly wanted to cover the Fed. So thanks for tuning in. Be sure to let me know if you have any questions. We'll get back to our question of the week there next week. You can feel free to reach out, send me a message, or just comment below, and we'll be happy to answer those in our weekly updates. Thanks as always for joining us. We'll see you next Thursday at 3.